Greetings, Series 65, 66 test takers. This is Dean Tenney coming to you from my studio here in fabulous Las Vegas. I recently was invited to participate or be a guest, make a guest appearance on a 65, 66 study group. And what I did for that guest appearance is pull some Kaplan questions that I thought were good to discuss and high probability on the exam. And I thought what I would do, because I know how many people on the channel love practice questions. So I thought I would share those with you. Shout out to Kaplan. Kaplan allows my viewers, subscribers, and members to get a free look at Kaplan questions like this. If you don't have a Kaplan QBank, I think it is the best paid supplement to your study materials. If you already have a Kaplan QBank, well, great. With my Guru 10 discount code for all Kaplan products and services, I think that can get this QBank brought in at about $60. So I highly recommend it. The best free supplement is certainly my 65 and 66 playlists on the YouTube channel. All right, let's get started explicating the 66 practice questions for the 65, 66. Aren't I clever? Oh, went the wrong way. Hold on, let me fix that. Okay, I think I got it fixed. Okay, so here's our first one. A client has 100 shares of GHA stock. When the company declares a 20% stock dividend, boy, you got to read carefully. You know, a stock dividend, you're not getting anything of real value like a cash dividend. And so as a test taker, you should certainly know that stock dividends are not taxable and cash dividends certainly are. After the payment of the dividend, the client has a proportionally decreased interest in the company. Now, you have 20% more shares, but so does everybody else. There's been no change in proportionate ownership. A proportionally increased interest in the company? No. No effective change. There we go. Ding, ding, ding. Right? I had 100 shares times 20%. I made 20 additional shares. The only thing I have to do is adjust my cost base to reflect that I have more shares at a lower price. A 20%, oh boy, are you confused, don't you wish? The answer is C. The answer is C. An ADR, you're definitely get test questions on American depository receipts. It's very high probability. The two things are to recognize what an ADR represents and also know you're subject to currency risk, right? If the underlying foreign business is conducted in the foreign currency, you have foreign currency risk. And then why would you buy an ADR, put it into a customer's portfolio? You're hoping that foreign security has different correlation than the US markets. A US security trading in a foreign market. And a foreign security in the US domestic market. I kind of like that one. Let's see what else we have available. A US security in both the domestic and the foreign markets. No. A foreign security in both domestic and foreign markets. No. It's a foreign security in our US domestic market. The one I always use in my lectures is Telephones to Mexico, but whether it's Samsung, the Korean company, or Toyota, Japanese, or Nestle, you can all get those foreign securities in the form of an American depository receipt. A technical analyst, you should be able to distinguish between technical analysis and fundamental analysis and what goes into each of them. Support and resistance. No, you should know the support line is the bottom line on a chart. You know, it's going to be the only time the charts look exactly like how they should have looked. But no, you know, support resistance is the top line. And, you know, if I'm a technical analyst, I might put a sell stop below the support, a buy stop above the resistance. So I'll either go short or long when there's a breakout, but it's not the answer to this question. Could have been an answer to a different question, but not this one. Odd lot trading theory. Odd lot trading theory. Theory isn't truth. It's just a way of explaining things. And the more theory can explain, the better that theory is. And so this theory says that if you can't afford to buy shares in the normal unit of delivery, which is 100 shares. You know, if you're buying an odd lot, that you are the dumb money and we should do the opposite. So odd lot trading theory says odd lotters are the dumb money and we should do the opposite. Could be a different answer to a different question. It isn't the answer to this question. Yeah, moving averages are going to smooth out my chart, right? I'm going to plot 120 days in advance, a previous move, and that'll take the edges off my charts. Advanced decline is for breadth of market to determine, what kind of a trend we're having. I mean, if the market tanks, but I got more advances than declines, there's not a lot of breadth there. But, if the market tanks and there's 10 declines for every advance, that confirms it, and that's called breadth of market. The answer here is C, moving averages. An analyst is attempting to determine the reasonable value for a particular common stock. There's different valuation methods. When comparing the result used by the two dividend models, it would be true to state. Now, remember, the two dividend models use discounted cash flow to see what I would be willing to pay today for a future set of those income streams from those quarterly dividends. You remember, one assumes the dividends are constant. The dividend is not going to grow. That's called the dividend discount model. The other model assumes that the dividends can grow. The board might decide to increase the dividend. So you can't use the dividend growth model on a preferred stock because the dividend is fixed or stated, it isn't going to increase. But on a common stock where it's rising, for example, Bank of America's quarterly dividend used to be 18 cents. Now it's 21 cents. And we can make an assumption perhaps that if things go well, that Bank of America might increase that dividend. It would be true to state that using the dividend discount model will result in a higher valuation than using the dividend growth. Now, I could justify a higher price based on the idea that my income stream is going to grow. So A is not true. B, using the dividend growth model will result in a higher valuation than using the dividend discount model. Ding, 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 ding. By the way, test taking trick, it's got to be A or B because those are mutually exclusive. They're mutually exclusive. It can't be A and B in the same universe. The valuation approximately same. Don't ever take warm fuzzy bailout like I can't figure it out or it'd be the same. No. The dividend models can only be used with preferred stock. No, the trick on the test is that you can't use a dividend growth model to do discounted cash flow on a preferred stock because the dividend isn't growing, right? So the answer is B. B is in boy. If a client wants her income to keep pace with inflation, inflation is too much money chasing too few goods, what would you recommend? Now, the minute when I see this question, I'm thinking either common stock, I might even beat inflation, but I'm also thinking of a TIP, a Treasury inflation protected security. Preferred stocks? No, man. Fixed income investment vehicles do not do well in an inflationary environment. No. Investment grade corporate bonds, again, fixed income investment vehicles do not do well in an inflationary environment. There we go. Treasury inflation protected securities. Remember, the principle that the US government owes you will be adjusted for the consumer price index. So that's a good way to keep pace with inflation, certainly. Ginnie Mae's, not so much. Again, those are mortgages that people pay are fixed. And so it's a tip. I can't imagine a draw in at least one, you don't get at least one question on Treasury inflation protected securities. I like this one. The key here is not to freak out. So what is the principal value of a TIP bond after 2 years? If the coupon is 5%, who cares? Has nothing to do with the answer to the question. And inflation is 8. Now, what they're hoping you do is you kind of freak out and say, oh man, I got to do 4% and then times 4% because it's semi-annually. So 8% times 4%. Oh, you can just simply say, okay, well, they're going to adjust the principal accordingly. So I'll just guesstimate that that's going to be 1,080, right? 8% on 1,000, another 8%. That would be 1,160, but then I know it compounds. So I just shop the answer, said, okay, I'm looking for a number that's above 1,160, which in this case is D. So again, just an example of where a lot of times on 65, 66, people think they're being asked to do a bunch of math and they're not really. They're just kind of asking to look at it and see what's going on, right? All the following instruments would likely be issued at a discount. The only money market security that isn't issued at a discount is negotiable jumbo CDs. T-bills are issued at a discount. Commercial papers issued at a discount. And zero coupon bonds, also known as originally issued discount bonds, are issued at a discount. So it's the jumbo CD. Jumbo means 100,000. And negotiable means there's a secondary market for it. It doesn't say here negotiable, doesn't matter to answer the question, but that's what that's about. Oh my goodness. One of your clients has been recloaded by her employer. She has $125,000 from the proceeds of the sale of her previous home. She's currently renting in her new location and needing time to get familiar with the area, plans to purchase a new home within 9 months. You should probably recommend. Now, this is again, high probability on the exam where they want you to come up with, a money market security or something liquid. We should have been able by process of elimination to get rid of common stock and preferred stock. Treasury bonds, 10 years or greater, I don't think so. Don't bring extra stuff in the question. Don't say what if they meant or they don't. That can get you in a lot of trouble. Given that answer set, it looks like that CD, we parked that in a 9-month CD somewhere, right? Did it say 9 months? I think it said 9 months, maybe 6 months, whatever the case may be. The investment return of a variable annuity. So a variable annuity, the way I think of it, is a mutual fund with an insurance wrapper. And that mutual fund is sometimes referred to as a sub-account or separate account. And you should definitely know that in a variable annuity, the investment risk is assumed by the annuitant, and it's based on the performance up or down of the separate account or sub-account. It's a security product. That's the part that gives it the security risk and reward. So it's A. An equity index annuity has a participation of 80%. So that means they're going to give you 80% of whatever the index does, but in no case are they giving you more than 12. This is very much on the test. If the underlying index should return 14%. So I'm going to take my 14% and I'm going to times it by 0.80. And that is 11.2. And that isn't above 12. So that looks like that would be my correct answer, right? Boom. Now, sometimes there's a minimum, there's a floor on it. Now, equity indexed annuities are not considered securities. Be careful on the exam about this. It'll never go backwards. So that account will never be debited. It'll never be debited, meaning if the market goes down 5%, there'll be no credit. Or if there's a minimum return, maybe they guarantee to give you 1% credit or something. But the idea that you can't go below wherever that reset is each year is why it's not actually considered to be a securities product. Because in theory, right, you can't lose your principal if we have that floor established there. An investor purchased a periodic payment variable annuity 5 years ago at the age of 56. So first thing I need to notice here is 5 years, 56. So now we're talking 61. So it doesn't look like there's going to be any problem there. The annual premium payments were $10,000. So that means 50,000 of the 62,000 was after tax money. So 50,000, and now we have 62. If the investor's in a 25% tax bracket, it needs to withdraw 18,000. So very testable. Last money is in, our first money's out. And so of that $18,000 that we're sending him, 12,000 of it, last in, first out, represents $12,000 that he has not paid taxes on. And then the 6,000 is a return of his original money that he put in there for an emergency. Doesn't matter, it's an emergency, that's just to get you hung up. The amount of tax due will be. So what I'm going to do is take my calculator. And I'm going to say, okay, well, $12,000 is LIFO times 25. And I get $3,000 as being the tax due. Very testable. I mean, if you're taking notes when I do these explications and go over these questions with you, maybe you make a flashcard, LIFO, last in, first out, very testable to know that on a variable annuity. All the following are true regarding variable annuities, except they may decline in value when the stock market falls. They have lower expenses, and they do not have lower expenses, right? Because you have both the securities products and you also have that insurance wrapper. And so that is not true. That's a wonderful thing about a variable annuity. When you annuitize, you can turn it into an income stream that you can't outlive. That's pretty cool. They're eligible for an exchange. That is true. The answer is B. The answer is B. Remember, this is an accept format. They do not have lower expenses than a mutual fund. Guaranteed cash value is a feature of which of the following life insurance policies? That's whole life. Maybe you get one question on traditional insurance products. I would make sure you understand that life insurance, very testable, should not be sold as an investment. And I would know capital needs analysis, that we need to sit down with our customer and see how much insurance he needs if something happens to him. How much principal, how much life insurance do we need if something happens to take care of the wife and the kids? In my friend's Jim case, I said, Jim, he goes, I don't want to make a bet with an insurance company. I got to die to collect. I said, Jim, it isn't about you. It's about if something happens to you as a senior partner at your law firm, your wife and kids are, aren't going to have the income stream from a senior partner in a law firm. And so we need to think about how much we're going to need to replace that. ABC Corporation has just uncovered a major accounting scandal with regard to the annual audited financial report it files with the SEC. What form will be filed to disclose this information? It's called a Form 8K, for material current event. And, by filing that with the SEC, it's also telling the marketplace that there's a material current event. 10Q is the quarterly report. 10K is the annual report. And then FinCEN is where the U.S. Treasury Department, where we send CTRs and we send SARs to. A company is reporting high earnings during the expansion phase of the business cycle would probably be characterized as counter-cyclical? No. Defensive? No. Defensive is a company, that's the more likely test question, by the way. Defensive is a company that delivers products and services resilient to the business cycle. Sector sensitive? No, it sounds like to me it's something that trades with the economic or business cycle. B. So a company that's reporting high earnings during the expansion phase of the business cycle would probably be characterized as cyclical. I would definitely know defensive as well. Pharmaceuticals, utilities, food, Historically, which of the following has been least vulnerable to inflationary risk? Inflation risk is very much a test question. It's common stock. So I would definitely know. Bonds, no. Remember, fixed income investment vehicles, A, C, and D don't typically do well. You could have got this right with what I call the Sesame Street trick. One of these things is not like the other. One of these things is not like the other. An investor currently owns 100,000 U.S. Treasury bonds. So I immediately am going to think credit risk and interest rate risk when I think of fixed income investment vehicles. And here it's a Treasury bond, so I don't have any credit risk. The most significant risk, I think, since I haven't had credit risk, would be interest rate risk. Legislative risk? No, legislative risk would be like they changed the Roth IRA or something. Senator Roth is no longer around. Or, oh, here's a great one, right? Congress changed it from a dividend of one corporation to another being 70 to 50. What Congress giveth, Congress can taketh away. And liquidity risk? No, Treasury. The Treasury, secondary market treasuries, is the most liquid financial market in the world. That's not true for sure. So the answer is B, interest rate risk. In response to an evolving marketplace, the SEC, through release IA 1092, expanded the definition of investment advisor to include all the following, except. So remember, we had people think, well, I'm not sure if it applies to me. So when you're not sure about definitions, what words mean, you write the SEC. Sometimes they're nice enough to put out an interpretive release and say, here's what we meant. We didn't make it clear, so here we'll make it a little clearer for you. Yeah, it definitely was about financial planners. It was definitely about sports and entertainment representatives who offer money management to their clients. Indeed. Broker dealers offering wrap fees? No, they're regulated, but that's not what this is about. It's about the release, not whether a broker dealer offering a wrap fee has to have an affiliated investment advisor. They do, but that's not what the question's about. It's about that release. Pension consultants, yes. So, you might want to consider maybe getting rid of the accept and now marking out C. If you maybe print this, I don't know, snippet or whatever, you can make a poor man's flashcard. And when you make a poor man's flashcard, then you actually have the right answer. In response to an evolving marketplace, the SEC, through release IA 1092, expanded the definition of investment advisor to include all the following. And I'll mark out except: 1, financial planners; 2, sports and entertainment representatives; 3, pension consultants. And now I have the things I'm supposed to know. To be in compliance with the Dodd-Frank Wall Street Reform and Consumer Protection Act, a federally covered advisor. Wow. I like this because, like the test, it just has a whole bunch of stuff that isn't meaningful to answering this question. I mean, that first part, it's about a federally covered advisor. So sometimes you might want to read the last sentence first or the last part of the question just to see where it ends up. A is permitted to use Form ADV Part 1A in lieu of a separate brochure. No, remember, that's not Form ADV Part 1A. It's Form ADV Part 2. Can be used as in lieu of a separate brochure. B, must disclose on Form ADV Part 2A the form of the organization of the business entity. No, again, that's on Form ADV Part 1, whether you're an LLC, your investment advisory firm, or an S Corp, or a C Corp, or a partnership. That's not true. Managing individual accounts may not have less than 90 million in assets. Yes, that's the floor, remember? That is the floor. Whose principal office has moved must file an amendment noting that change within 90 days of the year end of the investment advisor's fiscal year. No, the answer to this one is C, right? That's that floor for being a federally covered investment advisor. Which of the following would not be excluded? Very important, not be excluded from the Uniform Securities Act definition of a broker-dealer. So I personally always like to, when I get USA or any kind of an acronym, spell it out, Uniform Securities Act. So one of the challenges on 65, 66 is really to be clear what you're being asked. So what this question in plain English is asking is that one of these broker-dealers needs to register with the state administrator, needs to register the broker-dealer. So let's look at choice A. A broker-dealer has no office in the state. Now, when you have no office in the state, then it depends on who your clients are as a broker-dealer. So a broker-dealer with no office in the state, properly registered in another state. So I always like to kind of, get rid of the grammar problems by putting in a state. So whatever state you're in, I would suggest using. I'm coming to you from Las Vegas, Nevada. Nevada is my state. A broker-dealer with no office in Nevada, properly registered in California, that deals with residents of California who are vacationing in Nevada. That broker-dealer would be excluded from registering under the Uniform Securities Act. And we're looking for somebody who is not excluded, somebody who needs to register. B, a broker-dealer with no office in this state. Again, my suggestion, put a state in there. My broker, pick your state, I'm Nevada. A broker-dealer with no office in Nevada, properly registered in California, that deals with institutional investors in Nevada. Again, excluded. C, a broker-dealer with no office in Nevada, properly registered in California, whose only business is underwriting new issues of corporations domiciled in Nevada. Again, excluded. D, a broker-dealer with no office in this state, properly registered in another state. So I'm using Nevada. Broker-dealer, no office in Nevada, properly registered in California, and deals with fewer than 6 clients in Nevada. There is no de minimis for a broker-dealer. If a broker-dealer has 1 retail customer in the state, the broker-dealer needs to register. So here you got to be careful whether you're being asked about the broker-dealer and the investment advisor. The de minimis is for a state-covered investment advisor or an investment advisor rep. It is not for a broker-dealer. So the answer to this one is D. A major concern of broker-dealers today is ensuring the safety of customer data. Recommended methods for doing so would include encrypting files. Absolutely. Now, a lot of the vendors give you way too many multiple questions. On your actual exam, you'll get 3, 4, 5, maybe. So not overkill like some of the test prep vendors. Sure, customer passwords. Sure, biometric authentication. That's a layup. 1, 2, and 3. All those would be something we would consider. You would likely recommend a money market mutual fund to a client whose objective is. So I'm thinking here, safety, a principle, that's kind of what I'm thinking before I, do the reveal on the answer set. You kind of want to, contemplate a little bit about the question before you jump into the answer set. Capital growth, absolutely not. Capital preservation, that sounds pretty good. Let's see what else is available to us. Liberal income, absolutely not. Limited liability, well, it's a mutual fund at the end of the day. And We have had mutual funds that kind of break the buck every now and again, but the answer there in that answer set is B. That seems like our best answer to that one. Which of the following statements regarding registration of securities professionals under the Uniform Security Act is not true? So I like to put a T or an F next to these, in my own, my scratch paper. You should have your scratch paper out. A successor firm is exempt from paying registration fees until the renewal date. That is true. So maybe let me get out my annotation tool and show you what I mean as a test taker. It's time together as a buffet. If you don't like something, well, don't put it on your tray. But I'm going to say, okay, well, that is true. And I'm looking for something that's false. A successor firm is exempt from filing a consent to service. No. That is very testable. Know that a consent to service is a permanent part of a record. There's no situation in which you're going to be a securities professional, not have a consent to service. Very testable. Know what that is. That allows the state administrator to receive legal papers on your behalf. That is very testable. So now the neat thing about that, by the way, is now I know as a test taker that these next things are true. So I may or may not have known that before, but now I do. And maybe that's free information, perhaps I can use later. The administrator may require minimum financial standards for state registered investment advisors who exercise discretion in client accounts. Indeed, that's either going to be 10,000 or 35,000 based on the Uniform Securities Act template. So, the Uniform Securities Act is not actually the rules in your state. It's a template that the state administrators have agreed that if you pass a test on it, is sufficient to conduct business in their state. So, be careful. Anyways, that's true. When an agent with a registered broker-dealer terminates the association, both the agent and the broker-dealer must notify the administrator. That's true too. That's called a U5. U4 is how you associate with a broker-dealer, and U5 is how you disassociate. And so that is true. Yeah, remember we said, again, that's the false thing. Consent to service is a permanent part of your record. For which of the following new issues would a notice filing be most appropriate? And that's for federally covered securities. The big ones are mutual funds and New York Stock Exchange and NASDAQ. So the answer is C, as in Charlie. By the way, they're trying to get you hung up here on different exemptions for different things, right? So distractors are the technical name for wrong answers, for people who write tests. And both, Chuck Lowenstein, who's the guy who does the Kaplan Q Bank and the test, are very good at distractors, wrong answers that are right answers to different questions, right? So that can be a challenge on the exam. And even on your, if you buy the Kaplan Q Bank, a challenge there. By the way, it's intentional that the Kaplan Q Bank is trying to challenge you in the way that NASA challenges you as well. A sale or offer would not include. The state administrator doesn't care about a gift of non-assessable stock. Boy, be careful. 3 letters would change this answer. If this said assessable stock, it would be an offer to sale under the Uniform Securities Act. Non-assessable means there's no mandatory capital calls. And so, I'm not actually shedding myself of a liability by giving you these shares. If it was assessable stock and I gift that to you, I might be gifting to you a security in which there are mandatory, capital calls, and that would be a no-no. So that looks like a good answer. It looks like my best one. That's very testable. Let's see what B is. Any security given or delivered, or as a bonus or purchase. So consideration. You're taking a legal exam. I can't tell how many attorneys sometimes say, man, if I don't pass, it's going to be embarrassing. I go, it certainly is, because it's half of this exam, 65 and 66, is legalese, not plain English. You got to figure out what it means. So it's B is definitely an offer or a sale. So an offer is to sell is the same as a sale. A sale is an offer accepted. It's a transaction. And then here, it doesn't matter that it's a nominal payment. If it was a stock dividend with no payment, that wouldn't be a problem. But a nominal payment means consideration, and that means it's a problem with the state administrator, the Uniform Securities Act template. A sale or offer of a warrant or right to purchase to subscribe, a sale or offer of a warrant or right to purchase or subscribe to another security of the same or another issuer. Now, Here, I'm not quite sure where the consideration to purchase or subscribe. There we go. So it's A. You should definitely know A, by the way. Don't get hung up again on distractors. It's A, and that's very testable. An investment advisor has devised a charting system and wishes to advertise this fact to obtain additional clients. For the advisor to do this, the Uniform Securities Act would require which of the following? A, past performance since the inception of the system must be shown. Yeah, I don't know. Disclosure of the length of time the charting system has been employed. If the system is indeed foolproof, verification of that fact, oh my goodness, you could toss that one out right away. A statement as to limitations and difficulties involved in using the system. Yeah, given that answer set, I think D is my best answer. That makes the most sense. D is in dog. All the following would be considered unethical business practice except failure to state material facts. Absolutely. A material fact is the kind of fact that might alter your investment decision. Again, it's a legal test, and that's what that word material means. If you're trying to stay out of trouble, you'd say, I thought it was immaterial. I saw a securities professional being interviewed, and he was asked why he didn't tell this client the information. He said, I thought I'd lose the sale. That is the worst answer I can possibly think of. That means you knew it was material and you should have disclosed it. Trading on inside information, definitely a problem. You know, we have an Insider Trading Act of 88. No. C, forwarding a complaint to your supervisor. That sounds like a right thing to do for sure. Splitting commissions with an agent of an unaffiliated broker dealer. That would be a problem. And so it's C, forwarding complaints. That's what you should do. Your 50-year-old client has a 401k with a value of 100. Now, again, I think the key on these is not to get too hung up, out of the gate. So as I said, most of the time, what people think as our higher end math questions are actually not. So, the key is don't panic. It's mostly about inputs and outputs. So a 50-year-old client has a 401k with a value of 100. So, what I'm going to do is I say, okay, you got 100. It sounds like they're going to tell me something about this $100,000. So I think as my starting as a test taker, I think what I'll do is say, okay, here's my $100,000. And I'm just going to put that there. And okay, it says, what is the approximate annual rate of growth the account would have to experience so that at your client's retirement age of 70? So now what I'm going to do is say, okay, well, it looks like what we need to have this thing do is go from here to here. And when it gets there, we want to have $400,000. I'm going to put that there. And it looks like that time frame that we're looking at here is 20 years to go from 50 to 70. So that looks like that's that time frame for that. So let's see. I think maybe I could use the rule of 72. What I mean by that is I could say, okay, well, that means I'm going to have this money doubled twice. Right. So yeah, that doesn't look like I put that in the middle spot, but halfway to 50 and 60 or 50 and 70 is 60. That's going to be 10 years out, right? This entire time frame I'm looking at is 20 years, but halfway there is 10 years. So to make it to my financial destination, I'm going to need 200,000, 10 years, and I need to double that again. So again, if you don't panic, you kind of say, okay, well, how can I break this into different pieces? And then remember, this entire time frame is 20 years. Okay, so now the rule of 72 tells me how long it takes to double money, right? So now I'm in business. So I'm going to take, I need to double my $100,000 to $200,000. And when I take that and divide the rule of 72, right? 100 to 200, then 200 to 400. how long it takes to double my money, I come up with 7.2%. So again, this is looks like it's a higher math question. It's just really the rule of 72. So yeah, the rule of 72 says I can divide, and it will tell me either the return I need, or the principal amount that I need. Right, so that's 7.2% when I do that math. Let me clean up my slide. Which of the following securities would most likely reduce the volatility of your client's portfolio? So you should definitely know positive correlation. Positive correlation are things that move in the same direction, in this case, securities. Zero correlation, no discernible pattern, and negative correlation. This is very much a test question. The one I always use is, am I adding or doing anything or accomplishing anything in terms of diversification under modern portfolio theory? If you have Home Depot in your account, I put Lowe's in there. I mean, there's almost a perfect correlation. So what I'm looking for is a security that has negative correlation, goes the other direction. Now you'll see this either expressed this way with D as the answer, or you'll see this expressed as, least likely. So be careful on most likely, least likely questions, because it's very easy to get turned around on them. Very easy to get turned around on them. So D. Now, if they said least likely, the answer would be A. A company has current assets of $5 million and inventory of 2. So be careful. The 2 million and the 3 million are part of the 5 million. Current assets are cash or things we plan to turn to cash within 12 months. So the 2 million and the 1 million are already included in the 5, right? And the current liabilities of 3 million. ABC's quick asset ratio, also known as the asset test. Quick assets or quick asset test means don't count the inventory. So we're going to take the inventory out of the 5 million. And so now we have 3 million divided by 3 million. The answer is 1 to 1. Now, if they ask me working capital, that could have been testable. That's current assets, 5 million minus 3 million. And the working capital here would be 2 million. That's testable as well. They could have asked us current ratio. That would have been the current assets, 5 million, divided by the current liabilities, 3 million, right? And then here they asked the asset test. Determining volatility based on the security's historic returns is the purpose of computing. Again, you want to practice your ability to look at a question and say, well, it can't be beta. Why beta can't be the right answer is beta is about a measurement of volatility as compared to the market. And there's nothing in this question about the market, so it can't be beta. You should have been able to eliminate alpha. You should know that alpha is the excess returns over beta. And again, if there's no beta, there's no market in the question, then it can't be alpha. Book value. No, book value would be fundamental analysis. That's the theoretical liquidation value of the company. That's not it. It's got to be standard deviation. So again, as long as you don't panic on these questions, I think you're fine. Again, you might want to make a flashcard for this kind of stuff. Again, it's not, can you do standard deviation? It's mainly, can you pick it out of the lineup, so to speak. When a company's debt to equity ratio is higher, so debt to equity, the capitalization of a company consists of its long-term liabilities and its net worth, its shareholder equity. Right? That's how we capitalize corporations, with equity and debt. Equity and debt, that's the capitalization of a company. Now remember, long-term debt, the bond money. So the bond money and the shareholder equity. So it's saying debt to equity, we have more debt than is typical for our industry. That means we're levered, we're leveraged, we're being aggressive, and so we are highly leveraged. Now, kind of counterintuitive, but sometimes we say that companies trade on a little sliver of equity, trade on equity, and that just means trading on equity is that we have a smaller portion of equity on our balance sheet than we do debt. Which of the following bonds would be most sensitive to a change in market interest rates? Volatility. A good way to remember this is long and low. This also could be expressed on your test as duration. So what I'm looking for is the bond with the longest maturity and the lowest coupon. So here I have a 5% coupon, 20 years, 5% 15 years, 4% 1 year, so long and low. So the first thing I'm gonna do as a test taker is go to the longest term maturity, which is 20 years, and then the lowest coupon, which in this case is 4%. Long and low, long and low. The LMN Corporation has a bond with a 5% coupon that's trading at a premium. So again, what I like is the teeter-totter or the seesaw, because the teeter-totter or seesaw turns these kind of questions into, our judgment questions, into aim and shoot, point and click questions. So if you've been studying for a while, hopefully you have learned how to use the teeter-totter or seesaw. So this is a bond trading at a premium. So here's my seesaw, and it has a 5% coupon. That's the fulcrum of the seesaw. That's going to be 5% here. Oh. Right. And then we know that from the seesaw that these other yields are going to be the current yield. Oh. The current yield, the yield to maturity, and yield to call. And here it's asking me about which would be the highest, and it looks like it's going to be the nominal yield, also known as the fixed or stated rate of return, also known as the coupon. What will they call it on the test? Whatever you're concerned with. By the way, and the most likely question is not really the highest. They always test you on the lowest yield. So the more likely test scenario here is yield to call. Yield to call. The discount rate used in a discounted cash flow. So in discounted cash flow, remember what we're doing is saying, okay, what would be we willing to pay for a future set of income streams, right? In other words, you know, they ask you, you win the lottery. Do you want a check a month for the rest of your life? Or do you want a lump sum? And you'd say, well, let me do the discounted cash flow analysis and I'll let you know. Now, when doing that, we assume a return. And so you could use the T-bill if you chose to, but you know, it depends what you want to choose. You don't have to choose that to do the math. Yeah, current market interest rate for the value of the level of risk. Yeah. The future value of the stream of payments over the life of the security. No, the discount rate is part of the computation for that. No, it's C. That's our best answer. C, or excuse me, C. B, B, right? The current market interest rate for that level of risk is what we're going to use. I have real estate professionals I know that use the Treasury note. Some people use the T-bill. Some people use the historical return. The return we're comfortable that we can use in doing the math. An investor who purchased shares of an investment company at a premium to the NAV, and then 2 years later sold those at a discount from the NAV, very testable to be able to distinguish an open-end fund from a closed-end fund. And the only fund it could be trading for a discount to the NAV is a closed-end fund. You're going to get more than one question on that, and it's very testable. It is very testable to be able to distinguish closed-end funds from open-ended funds. A unit investment trust is a professionally selected fixed portfolio. Fixed portfolio. That's the way we sometimes say that as passive management. And an open income fund is a traditional mutual fund. And a face amount certificate company is illegal in most states. That's also known as a contractual plan. When comparing hedge funds to traditional mutual funds, the whole point of setting up a hedge fund is to avoid the Investment Company Act of 1940. We lose traditional mutual fund managers who leave and start hedge funds so they can do all kinds of crazy things that they cannot do when managing money that has to comply with the Investment Company Act of 1940. Generally employ the use of leverage through margin. Yeah, traditional mutual funds do not do that. Hedge funds certainly do. No, not a lower operating expense. Are you kidding me? Absolutely not. You know, the traditional expense model is 2 and 20. 2% of the assets I'm managing as a hedge fund and 20% of the profits I make you. They are way more expensive than traditional mutual funds. They can short, and they are generally not registered. Yeah, the fund itself is not registered. Usually the manager is a federally covered investment advisor, but the hedge fund itself is a private partnership that is typically not registered. And so the answer is B. The price to purchase an ETF, very testable again, to be able to distinguish between an ETF and an open-end mutual fund. How are they different? And this is one way how they're different. A traditional mutual fund, remember, is doing business directly with its fund shareholders at the next calculation of the NAV. That's called forward pricing. And some people don't like forward pricing, and that's not true of an exchange traded fund. Nope. That's A is a mutual fund. This is not a mutual fund. There we go. Supply and demand. It trades supply and demand in the secondary market. Boom. All the following are considered benefits of mutual funds except, yeah, you get diversification. You know, the easiest way to avoid selection risk or non-systematic risk is to purchase a mutual fund. So you've eliminated or mitigated, I should say, non-systematic risk or selection risk. Now, you haven't got rid of systematic risk. I mean, risk prevails despite your diversification. But that's a wonderful thing about a mutual fund. A breakpoint sale, a breakpoint is good. It's a quantity discount, but a breakpoint sale is not. No. Very testable. A breakpoint sale is a fraudulent device. It's when I try and maximize my commission by avoiding the breakpoint. And no, that's not good. Liquidity, yeah, you got guaranteed marketability. At the next calculation of NAV, they have to meet redemption requests within 7 calendar days. So that's a wonderful thing. Yeah, professional management. Do you have the time, temper, and expertise to be managing money? If not, you can hire a money manager in a mutual fund. That's the easiest way for most retail investors to avail themselves of professional management. So the answer there is B. That's not a good thing. Breakpoints are good. Be careful. Breakpoints are good, quantity discounts, but a breakpoint sale, not good, not bueno. That's when you try to avoid the breakpoint to maximize your commission. An investor takes an option position that obligates her to buy. Obligate. So the minute you hear obligate, you say potential victim, and you say short the option contract, short, seller, or writer. Now, again, I'm always torn on 65 and 66 about how much work you want to do on options and futures and some of the more exotic stuff. I mean, if you're taking a 66, this should be, look a little more familiar to her, perhaps. But boy, 65s, if you're a tabula rasa, blank slate, and you're not a 663 and you're just taking a 65 for a fee-based investment advisory firm, this is a tough one. I keep putting the options lectures into the playlist and taking them out, and I just can't decide. But anyways, that's up to you, I guess, is what I'm saying. You're going to have to decide, how much you want to work you want to do here. But this is the most important answer set in terms of options. So this is the most important answer set. And, here a long call is a choice. Let me get a different color here. A choice to buy the stock at the strike price. XP means strike price, when you're talking about options. And so, this answer set is the most important. And as you see here in our example, it says obligation. As I told you, obligation is going to be a short option contract. So here's a choice. This is a choice to sell the stock at the strike price. And again, I'll leave it up to you to decide how much. You maybe make a flashcard, or I have an options matrix for you. I have 20 hours of lectures on options. So, I mean, it's not that those are not there. Maybe watch the basic options lecture. That's you're 2 hours in, and that's basics. I mean, that might be a good investment for you. Anyways, let's look. We need a obligation. Short means obligation. So long means choice. And there's a lot of ways they say long. We could say long, buyer, owner, holder, lots of ways to say short, seller, writer, but potential victim, obligation to sell the stock at the strike price. And now we're going to have a 50-50, assuming we know this answer set. And I think this answer set is the most important thing about options as it relates to being a 65 or 66. And let's see, let me just move that up. I'm trying to get in the right spot here. I'm not sure why I can't find my. I'm trying to put it on the same line as the answer set. So maybe you want to, hit pause, and maybe when you hit pause, maybe you want to then, make a flashcard on this. And a short put is an obligation. Let me make sure I have enough room to put it in there. Obligation to buy the stock at the strike price. And so now that if I know that answers that, key point, if I don't know that answers that, I'm just going to be staring at it going, I don't know, right? So here, obligation to buy. So that is a short put. That is a short put. Your client owns 100 shares of XYZ purchased 3 years ago at 32. It's December 21st. XYZ is now trading at 52. Looks pretty good. Your client believes the stock is about to enter a downtrend. What strategy could she use to protect her gain and still allow her to take advantage of the upside movement if her belief is incorrect? So I'm thinking here, when I see this, of a sell stop, or I'm thinking about a put. And with a sell stop, I might get bumped out of the stock. It gets triggered and I sell the stock. So one thing we can do to protect our profit is to place a sell stop somewhere below 52, but it says, and still allow her to take advantage of the upside if her belief is incorrect. Okay, so let's see what answers are available to us. Buy a 50 call. Well, we should have been able to eliminate that because we already bought the stock and we're interested in being able to sell the stock. So we should have been able to eliminate that. Buy a 50 put. That's a choice to sell. I kind of like that one. I like that one so far. And again, I said that's the most important thing, is the answer set, to be able to know that's a choice to buy. A is a choice to buy the stock at 50, and B is a choice to sell at 50. Sell a March 50 call, that's an obligation to sell. And I actually own the stock. That's covered call. And the problem with the covered call is it would be called away from me at 50. And so it can't be that one, because it says here she wants to take advantage of the upside. And if she sells that 50 call, she's obliged to deliver the stock at 50. So she would not be participating in that. Obligate herself to buy the 50, buy the stock. No, she's already done that, right? So what she's interested in is protection. For protection, you buy the option, and for income, you sell the option. So B, she establishes the choice to sell at 50. That's called a protective put, a put that is protecting the stock position. Now, again, I have a little carve out lecture of 15 minutes on that one. That would be another way you might want to proceed, as a 65 or 66. I don't know if I have that in the playlist. Maybe I do, but if I don't, you can just go to the 150 plus videos. It's a buffet, right? And you can find the one called protective put. It's 15 minutes on just this strategy. So maybe you want to check that out. The RIF corporation would not be able to issue. So this is testing you again on capitalization of corporations. We said corporations are capitalized with either equity or debt. So we're looking at something that REF is not going to be using to capitalize itself, the corporation. Call options, absolutely not. When somebody exercises a call option, the corporation doesn't receive the proceeds. When they exercise a call option, the person who sold the call is the one who has to deliver the stock. That's a secondary transaction, not a primary transaction. Very important language on your 65, 66. Primary transactions are where the issuer receives the proceeds. And all those transactions together are called the primary market. And then secondary transactions are where the previous owner receives the proceeds. And all those together are called the secondary market. And, to be honest with you, the state administrator, 65, 66, NASA is much more concerned with the primary market from a registration regulatory framework standpoint than that secondary market. So I like A so far. Yeah, when they issue common stock, they certainly do that. It says would not. And yeah, if we need some more equity financing, RIF is going to issue some more stock. If people exercise the rights, the issuer receives the proceeds. and that would provide additional equity financing. When people exercise the warrants, that definitely provides additional equity financing if people choose to exercise the warrants. I would definitely be able to contrast rights and warrants. Rights are short-term and at issuance are exercisable below the current market price. I mean, they already have in terms of value, and warrants are long-term and at issuance exercisable above the current market price. Now, where calls, rights, and warrants are all the same is they're all what we call derivative securities, So call option. In January, now I've been thinking for a long time, I actually opened up a series 3 playlist. I think all I got is, what is the series 3 about? And it's on my agenda to do a little something on commodities for 65 and 66. I'm just a little torn about whether it should be a little, carve out lecture or maybe just, 10 sample problems like this. But, maybe 1 or 2 futures commodities positions. If you tell me you missed the 65, 66 because of futures, I don't believe it. All right, well, let's look at this. Again, a key is not to panic. If you didn't know anything about futures contracts, you could still kind of muddle your way through this. In January, the July soybean futures contract is being quoted at $5. Believing soybean futures are going to increase, or soybean prices are going to increase. So that means you're bullish. You think the price is going up. So if you think the price is going up, you go long the futures. If you think you're going down, you go short the futures. So an investor purchases a July soybean futures contract. So I'm long July soybeans. In May, the price of the July futures is increased to $5.50. That's pretty cool. Oh, excuse me. I didn't have time to kill the mic before that happened. And you take your profit. So if I bought this for $5 and I sold it for 50 cents, I really don't think I have to know anything really about commodities to know that if I made 50 cents on, 55,000 bushels, by the way, that's always given the size of whatever the futures contract is. I think if I do that on my calculator, I'm going to get one of these answers. So 50 cents times 5,000, I'm looking for $2,500 as my gain. All right, let's see if that answer is available to me. 250? No. There, ding, 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 ding. Right, so don't freak out on futures. They are there on the 65. I would know the difference between futures contracts. They're standardized and that kind of thing. So, an investor in a direct participation program, also known as a partnership, would at least likely enjoy which of these benefits? Boy, grammar again is purposely bad. Kaplan's trying to prepare you for that. Again, shout out to Kaplan. If you want the Kaplan Q Bank, which I highly recommend with my Guru 10, is about $60. And the Kaplan Q Bank is the best Q Bank, in my opinion, for having a Q Bank that you can manipulate lots of questions, take quizzes, identify weak areas, go back. And if you're a Kaplan student, you already have it. If you're a Knopman student, you already have it because Knopman uses the Kaplan Q Bank. But if you don't, I think it's a very worthy of your investment. All right. Anyways, tax credits is a good thing. We love that. And I would definitely know that's for historic real estate, direct participation programs where we go buy historic real estate and restore it to its former glory, and low income housing. So we have a direct participation program, a partnership that does that, tax credits. Capital gains are wonderful. Passive losses may or may not be a problem because I can use passive losses to offset passive income. So, I'm going to see what D. Yeah, that's it. Lack of liquidity. You should definitely know partnerships, direct participation programs have a lack of liquidity. You can't get in or out without permission of the general partner. An investment advisor would be expected to use heightened suitability standards before recommending any of the following except. So I'm thinking one of these things is a lower suitability standard, more of a plain vanilla thing than the other things. ETNs, no. ETNs are heightened suitability because those are exchange traded notes. very testable. Those are debt instruments. And, the sponsor may not be able to pay you what they promised you. You should definitely know the exchange traded notes, sometimes referred to as equity linked notes, sometimes referred as structure notes, do require heightened suitability. And the thing is, the investor needs to understand they're buying a debt instrument that's linked to an index or whatever it is. That sounds like a plain vanilla product. I mean, that's been around a long time. My friends at T. Rowe Price have been making growth investments in their mutual funds for decades. We know how that works. That is indeed a plain vanilla kind of a product. A is what we call a structured product. B is not. Inverse funds, oh man, those are structured products. They go the other direction. And sometimes they might miss the mark in terms of what they said. 2 times may not be 2 times because they got to do the reset on it. That is certainly something that requires heightened suitability. A is a trading vehicle, B is for long-term, C is a trading vehicle, a speculative vehicle. I mean, the people using them are speculators. And leveraged ETFs, indeed. So given that answer set, B is in boy. One reason is clients might add gold to their portfolio. This is high probability on the test. It might not say gold. Sometimes they say precious metals, but it's definitely on your exam. And no. And there we go. As a possible hedge against inflation, I like that. Maybe different correlation to financial assets, maybe be another good answer. But I like that answer so far. Because of gold's high correlation to the stock market, absolutely not. Again, if the market goes down 10,000 points today, we expect gold to go up. So gold has a different negative correlation to liquid financial assets, according to the test. That's not always the case, but that's the test case for sure. Yeah, boom. Definitely need to know that for your exam. Which of the following business structures has a statutory limit to the number of investors? This answer set is very testable. Very testable. So, maybe you want to make this a flashcard answer set. C Corps do not have a statutory limit to number of investors. So if we want to raise a lot of money and have lots of shareholders someday, C Corp would be the way to go. Now, what C Corps do have that others don't is retained earnings. And so if there's losses or earnings, let's talk about losses trapped within that corporate shell, or if they have earnings, remember, there may not be a distribution. If there is, they pay a dividend. The corporation pays taxes, pays you a dividend, you pay taxes, money gets taxed twice. The others here are what we call flow-through vehicles. The profits and losses flow through to the owners. So LLC, partnership, and an S Corp all are flow-through. And the one that has a statutory limit to the number of investors, very testable, is an S Corp, and it's 100 shareholders, and they all have to be residents. They can't be aliens. They got to be citizens is the way to say that. Family balance sheets. I say, for me to do a really good job for you over time, I need to know more about you. So what I'd like to do here is create a balance sheet as of today. That's what a balance sheet, a picture in time as of today. I'd like to go over your current assets, your long-term or fixed assets, your current liabilities, your long-term liabilities, establish what your net worth is. And then what I'm hoping is in our journey together financially, maybe we can get that net worth number up. And we can revisit this. Corporations do this every quarter. Maybe we want to do it every 6 months, whatever the case may be. Cash in the bank absolutely shows up on the balance sheet. No, salary is on your income statement. I say, once I get the balance sheet done, let's look at money coming in and money going out and see if perhaps we can't find some money somewhere to maybe do some dollar cost averaging, for example. But salary isn't on the balance sheet. That would be on the income statement. The value of a 401k, absolutely on the asset side of your balance sheet for sure. Credit card debt for sure on the liability side of your personal balance sheet or family balance sheet. The answer is B, salary. It's axiomatic that investors with long-term high time horizons should maintain a higher percentage of their assets in cash. No, it's the opposite. Axiomatic. By the way, when you don't know what that word means, I had a young lady, she's been one of my favorite students over a long time. Can you imagine this? She, I joke, I come into your life for a reason and a season. The reason is to pass your exams. And typically, the people, there are 3, the SIE, the 766. we support other exams, but that's typical. And that was her case, right? She's matriculating through these. And usually when people get through that, the reason of the season, they move on. I don't take it personal. I mean, it's the nature of the business that I've chosen, right? But anyways, her primary language is Mandarin, and she would call me and say, Dean, these words aren't even in my Google Translator. What can I tell you? So if you're struggling with like word, go for the context. And I told you another test taking trick right here is that A and B are saying kind of opposite things, right? And so when we have two questions that say opposite, as a test taker, I can use a trick called the principle of mutual exclusion. I think it's got to be one or the other. I say Socrates is a dog. Socrates is a philosopher. He's either a dog or a philosopher. He can't be both. He can't be both. So I'm thinking it's A or B, and I don't like A, but I do like B. Let's see what else is available to me. A smaller portion of their portfolio to equities than if they had a short-term horizon. Stay out of the stock market, invest in gold. No. Yeah, given that answer, I said, I think B is our answer. Even we didn't know axiomatic, we could have used the context of the answer set to arrive at our answer. A portfolio manager makes investment decisions based on market signals. So that sounds pretty aggressive, right? He's based on his signals getting in or out of his investments. This manager is probably using which portfolio management style? Buy and hold? Absolutely not. Passive? Absolutely not. Strategic? No, strategic means you make less moves. Tactical? Yeah, you make more moves. You make more moves. Sometimes I joke, people say, where was your MOS, your military occupational specialty in the Marine Corps? And I say it was intelligence. And then I have to tell them that's not strategic in the Marine Corps, tactical intelligence, meaning what's behind that tree, right? So not strategic, stuff about ICBMs, that kind of thing. Which of the following information which stock would most likely be included in a portfolio following the growth style of investing? So if I'm following the growth style of investing, I expect little or no dividend payout ratio. I expect a lower yield. I mean, the only two ways I make money in investment is income stream and or price appreciation. And so here I would think little income stream. I'm into it for price appreciation, being able to sell it to someone else for more than or less than I paid for it. I'm thinking a higher price earnings ratio because I think earnings will grow and that will be justified later on by higher earnings. The opposite I'm thinking would have a higher dividend payout ratio, a higher current yield, a lower PE, because the opposite would be value. Okay, so let's see what our answers are. So our first says ABC with the dividends at 225 and a current market price of 50. A lot of ways to do these things, but I'm going to take 225. I'm going to divide it by 50. And I come up with a current yield of 4.5%. That does not sound like a growth stock. 52-week price range, it's on the lower end. That doesn't look like that. That looks more like a value stock than a growth stock. Let's look at choice B. Choice B has dividends of 50 cents, a current market price of 9. So again, I'm saying, wow, 50 cents. Let's see what the current yield is on this. Current yield is what it pays me divided by what it costs me. That's very testable. So you shouldn't be fumbling around with the math I'm doing. 5.5%, again, does not sound like that as a growth stock. It's on the lower end of its price range. It sounds like a value stock. A dividend of 25 cents. And we take our 25 cents. I got my calculator here. I divide by 22. About a 1% current yield, not a big current yield here. A current market price at 22. Looks like it has some upward momentum because it's trading on the higher end of its price range of 14.45. It's way 210. So far, that looks like different than A and B for sure. So I like C here so far. Let's look at our next one. D is JKL. It has $1.05. And I take $1.05 and I'm just seeing what the current yield is. 22. 4.7%. Wow. That's a high current yield. It's on the lower end of its price range. So it sounds like value. Yeah, the answer here is C. C. According to modern portfolio theory, which of the following securities would least likely reduce the volatility of your client's portfolio? Theory isn't truth, it's just a way of explaining things. Now, remember, this is the opposite of the previous question, right? So now they're saying you really haven't accomplished much in terms of modern portfolio theory by putting a stock into the portfolio that goes the same direction at almost the same rate, right? So last time we saw this, it was most likely, and it was D as in dog. This time we see it, it's A as an apple, because last time it was most likely, and this time it is least likely. Boy, RTFQ. Read the full question. That's what RTFQ stands for. And read the full answer set. Read the full answer set. Have you done this yet, where you answer a question, you feel pretty good, and you answered the question you thought was there instead of the question that's actually there? A bond dealer is doing a cash flow analysis on a Ginnie Mae pass-through certificate. Whenever we have mortgage pass-throughs, we use average maturities to do our discounted cash flow analysis. So it would be A. That's just a flashcard recognition question. Many parents prefer to use a 529 over Coverdell educational savings account to finance their child's education for all the following reasons, except this is testable. So make sure you can contrast a 529 with a Coverdell. Funds may be withdrawn tax-free if used for qualified educational expenses. B is certainly an advantage. They both kind of have A as seems similar, and they're asking me, difference, right? It looks like A because I'm looking for why do you not choose the 529 over the ESA? B is a definite advantage to the 529. C is a definite advantage, and D is a definite advantage. I mean, you can take 15 grand times 5 out of your estate. So the answer is A. Both of them are similar in that regard. Which of the following actions taken by an administrator of a qualified retirement plan would not be a violation of ERISA's rules on fiduciary responsibilities? I think an administrator borrowing from the plan is a problem. Lending money to the plan is a problem. The thing you should be doing is maybe farming out the money management to a federally covered investment advisor. C sounds to be a fiduciary kind of a decision. Delegating responsibility for management of the plan's portfolio to an outside third-party federally covered investment advisor. Absolutely. Maintaining a brokerage account, joint, no, that would be a problem, right? Because, who's the trade belong to, the administrator of the plan or the plan, right? So C is in Charlie. Which of the following benchmarks would be most appropriate for a portfolio manager who concentrates on large caps? This is testable. It's the S&P 500. For a small cap manager, it'd be the Russell 2000. And I would also, as a test taker, know about the Wilshire 5000. The Wilshire 5000, the answer there most closely approximates the total US stock market. So those would be the indexes I'd be aware of as a test taker. An investor purchases 100 shares of KAPL common stock on June 1st, 2015 at $20 a share. On December 2015, the stock is sold at 21. Which of the following statements is true? The annualized return is, well, let's see what the holding period is. So I made $1, right? I'm going to take the 21 minus 20, and that's how I made $1. And then I spent the $20 to make that $1, and so I made 5%. So the holding period was 5%. Now it's 6 months. So if I could do that twice in the year times 2, the annualized return is 10%. So the holding period was 5%, and the annualized is 10, which is choice 2 and 4. A corporation has a 5% bond maturing in 10 years that has a current yield to maturity of 4.5. So as a test taker, you should know that that's a bond that's trading at a premium. So it's trading at a premium. The bond is callable at par in 5 years. Which of the following statements is correct? The yield to maturity is higher than the yield to call. You should definitely know a bond at a premium, the yield to call is going to be the lowest yield. And you still decide you want the bond as an investment advisor representative. You may still want to put it into the investor's portfolio, but to do that, you need to know what the yield to call is and how that compares to other bonds out there. If that's still an attractive yield, by all means, buy the bond. That's the whole point, by the way, so you can compare apples to apples and not apples to oranges. The yield to call is higher. And by the way, remember test taking trick there? Those are mutually exclusive things, it looks like. The yield to call is higher. Boom. Now remember, test taking trick is I almost know it's got to be A or B, because remember, principal mutual exclusion, they say opposite things. They say opposite things. All those following statements regarding an investor with a short stock position are true, except. So I've sold securities I don't own. I've sold securities I don't own. I've borrowed the securities from my broker dealer. My broker dealer says, Dean, we do have a customer who signed a loan consent form, and so you can sell these securities short. Now, don't forget though, Dean, at some point, you're going to have to return the borrowed securities. You're going to have to go in the open market, buy back the securities, give them back to the person you borrowed them from. So I'm hoping to sell high and buy low. The position could be protected through the purchase of a long call. Yeah, that would be a smart thing to do. Have a choice to buy back the borrowed stock at a set price anytime between now and expiration. Yeah, that's a great thing to do. The position could be protected through a buy stop. Yeah, both A and B are great arrows in my quiver to protect this short stock position from moving against me. We call a buy stop a stop loss order. And choice A, we call that a protective call, a call that's protecting the short stock position from moving against us. So A is true, B is true. I'm looking for something that's false. The position could be protected through a buy limit. And in a buy limit, it's not protected because I only want to buy it if I can have my price or less. And that means if it's never my price or less, the stock continues to go up and I continue to hemorrhage money. A buy limit may or may not be executed. Buy stop, ding, it gets triggered and I market order, I'm out of here. Yeah, if you don't do A or B, you're exposing yourself to potential unlimited loss, and C doesn't protect you. So the answer there is C. An investor enters a order buy DMF at 25.50 stop. So I'm telling my broker, if the stock trades at or through 25.50, buy the stock. So I'm done at or through. Now, Veritas will know where we place orders in relationship to the current market price. And a buy stop is going to be placed above the current market price. If the market price goes below 25.50, now remember, buy stops are placed above. So maybe I have this above example, the resistance level. Maybe the resistance level is 25. And I'm looking at the chart and I put my buy stop at 25.50 to go long. The market goes to or above. Yeah, remember, at or through, it becomes a live order. B looks pretty good. The order does not need to be triggered. Yes, it does. It doesn't become live unless it's triggered. The order cannot be executed. No, it's a market price goes to or above 25.50, pull the trigger, and I buy the stock. A market maker in an over-the-counter stock buys at the bid. I think the easiest way to get a handle on this. Again, I think this is a bigger challenge if you're at 65 than a 66, because we're hoping, that if you're a 66, you just took a 7 a while back, and this is a little more familiar perhaps to you. But the bid is the price at which the market maker buys, right? And the ask is the price at which the market maker sells. The customer, whenever they're looking at two prices, the customer pays the high price and always receives the low price. Again, I'm not sure if I have it in the 65 playlist, but I have a little carve out small lecture on just this. It's called Know Your Bid from Your Ask. Know your bid from your ask. And again, if you're 65, I highly recommend you go watch that 10-15 minute video. A looks like the right answer. A looks like the right answer. Let's see what our other choices are. Sells at the bid? No. Market maker sells at the ask. Buys at the offer? No. Buy at the bid. Boom. A. K1 is the pass-through. So they're asking about which person here or which investor is not going to see the K1. K1, remember, are for those pass-through vehicles, partnerships, S corps, LLCs, that kind of thing. Yeah, sure. You should definitely know it's not a C corp. Remember, the whole point again is the C corp. That answer set is very testable, and a C corp, remember, has no pass-through. So I like it. I'm not so much. I wouldn't get hung up on the K1, but as I said, you're going to get that answer set. And so maybe you want to make some flashcards about the appropriate answers for those business structures. It's only testable as a potential client of your, as an investment advisor rep, but also remember in Form ADV and Form BD, you have to tell them what business structure you choose. Are you going to organize your BD or your investment advisory firm as a S Corp or C Corp or partnership or an LLC, whatever the case may be? A business entity reports an operating loss for the year. The loss will not be of any tax benefit. Here we go again, right? It's the C Corp because, again, there is no flow through. Which of the following statements is not true? Which of the following statements is not true? Right? I wouldn't worry about this one. The answer is B, but who cares? I wouldn't worry about this at all. So, every once in a while I just like to throw in an outer space, question. Which of the following would be prohibited actions by a registered investment advisor? Disclosing the most intimate details of a client's portfolio when requested by the court as part of an IRS audit. Yeah, absolutely. The government wants to know anything about you. I'm going to tell them. I'm going to roll. I don't do that unless it's a quarter. The opposite of this is I'm not supposed to share your private information with other people. I can't tell how many people I see break this rule all the time, like, bragging that they're managing money for some person, and without that person's permission, you're not supposed to be, chatting or spreading their business about town. B, disclosing or recommending a security for which you will be compensated as an agent of the sponsor and broker dealer. That's what you're supposed to do, right? You're supposed to disclose any conflicts. Sunlight is the best disinfectant. You're not supposed to tell one person to buy and another person to sell the same security. That's a problem. That is a problem, right? By the way, be careful on this. Every once in a while you get hung up on this. Recommending both sides. Telling one person to buy, one person to sell. It's going to be different if, I'm not telling the parties to buy or sell. I'm telling one party to buy, and I happen to have a customer who wants to sell. That's a different scenario. Failing to disclose financial impairment to an advisory client. Financial impairment, remember this word, is material. So if I have a financial impairment that will prevent me from doing what I promised to do for you, that would be a problem. Failing to disclose for whom you do not have discretion. Well, I can't have financial impairment if I don't have discretion or custody. I can't steal what I don't touch, and I haven't collected any prepayment, so I have no contingent liability or substantial. So that's why that's not a problem. D could have been a problem, but it's not a problem because I don't have discretion, I don't have custody, and I haven't collected a substantial prepayment. Again, protected by, right? We want to be able to buy this. Well, if I have 200 shares, I need 2 contracts. Each option contracts governs 100 shares. So one doesn't work. A is good, but there's no such thing as being partially exposed, right? So if I'm short 200 shares, I need something that will cover 200 shares. That means I need 2 contracts. Ding, 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 ding. Okay, well, I hope you found that helpful. Shout out to Kaplan again. Kaplan allows my viewers and subscribers and members to have free looks at Kaplan questions like this. This was some questions I pulled as a guest appearance at a study group. I didn't go through all these, but I got through some of them, and I know that on the channel, you guys like practice questions. We now have in the 65 playlist and the 66 playlist, different playlists, but there are 2 practice finals. One, my practice final based on debrief and what people tell me they see, and then Brian's Test Geek Exam Prep LLC. And now you have these additional practice questions. Soon there'll be a third. I have permission from Kaplan to put up a 65 Kaplan practice final and a 66 practice final. I'll do the same thing I've done on the 7. I'm getting better at that. Be patient with me. I'm blowing up the screen. I'm trying to get better at reading, realizing that people are maybe using their smartphone or tablet instead of what I'm using, which is a 27-inch screen. So I'll try and make that as big as possible. And on this, I'm trying to get better too at reading you. Some people tell me they're using the channel on an audio basis only. So I'm trying to get a little better at slowing down and reading you the question and the answers. So if you are using this as an audio, kind of a podcast idea, then maybe it'll be more productive than some of my earlier lectures. So stay dedicated, stay disciplined, and be looking for some additional content coming your way soon. And I will see you next time. I'll probably put this for a premiere And usually when I post them, remember, it takes me a while to get the timestamps done. So if you find a brain fart or rural errata, let me know. Every once in a while, I mess up on something. And if I do, you can find the corrections and the timestamps in the video descriptions. All right. See you next time.